Want to become a millionaire without winning the lottery or building a tech startup? Well, in this video, I'm going to break it down in 5 clear strategies using real math, real tools, and realistic strategies that literally anyone can use, even if you're starting with just $10. Let's jump right in. Now, before I continue, I would love it and really appreciate it if you like and if you subscribe to my channel. That would be amazing. All right, with that, let's get into the nitty gritty. And specifically, I wanted to start out with a question. What is wealth for you? Because some people, for them, wealth means different things. In fact, I actually did this with a couple of my friends the other day and asking them like, hey, what is wealth for you? And the answers were interesting. First, someone said what you would probably imagine, having a bunch of money for retirement or just building up a lot of money. But another person said, hey, for me, wealth isn't necessarily the money part. It's more so the fact that I have time to spend specifically with my family, right? So in other words, for them, it was about like a beautiful paradise, as you can see here in this picture. And then another person, I actually also got this from online, and I wanted to share this with you. Check this out. This here is also what someone believes would be wealth to them. So this person was at Microsoft, which, as we know, is a pretty reputable company. They were a principal, meaning they were probably making a couple $100,000, if not millions already, with bonus money and all, for, I think it was a very long time. It was like 23 years basically total, right? 21 years here, and then another year and a month here. So we're talking probably like 22, 23 years, which is a long time, right? And guess what? What they did? They wanted to become a goose farmer. And I just thought this was amazing. This is maybe a meme you might also have seen across different forums, but I just thought this was a fantastic symbol of what wealth means to different people. Some people, to them, wealth means being a goose farmer. Others is retiring in a beautiful tropical island, and others is having a ton of money. So the question is, what is wealth to you? I want you to, and if you want, write it in the comments below. I'd love to know what wealth means to you. With that, let's get into the steps, because here's exactly how you can actually achieve that wealth, whatever it means to you. So first is crunching the numbers. Not all of us. So there's something called a poet, if you're a poet, and then there's others who are quants. So I myself, I'm probably leaning more toward the poet side. And these are people that like more language, more reading, more writing, that stuff. Quant people, they really love crunching the numbers. Now, if you want to build wealth, I'm not saying you need to become a quantitative trader and know, the super in-depth pieces of stock trading and everything. No, I don't mean that. But you still need to be somewhat familiar with the numbers, but it's actually not too bad. It's fairly straightforward. So in this section, I'm going to show you exactly what I mean by crunching the numbers. And the key point here is, and I'll zoom out here, you cannot just save your way to wealth. And by saving, I essentially mean, let me zoom out, hoarding cash, okay? I've actually seen this happen to a few of my former clients where they essentially saved money, and they saved and saved and saved, and they put it in a piggy bank or in a savings account, right? And that's it. And they're just like, okay, well, I saved a ton of money. I saved like 40%, literally. Someone saved 40% of their income, but they kept it in cash. And I was like, okay, you're there halfway, but you're not there 100% of the way. They're missing out on something. And this is what I mean by crunching the numbers. The reason why you can't just save your way to wealth is because you need compound growth. How do you get compound growth? Through investing your money. You cannot just keep it in cash. And here's why. So I want to show you and take a look at savings rates versus inflation, right? Inflation is that key item that's going to nibble away at the purchasing power of a single dollar. That's why oftentimes we look at retrospective prices, right, from like, 1930s, and we often say like, oh my gosh, a movie theater ticket was like 99 cents, and nowadays it's $20 or whatever it is, right, with inflation, like 100 years later. And one of the reasons why is this thing called inflation. So with that, let's take a look. So I wanted to show you this chart. I thought this was pretty interesting. Again, coming from the quant side, coming from that numbers perspective, to compare what you would earn, what your cash would earn if you parked it in a savings account, like at a regular bank, versus what inflation is actually doing. Like how high is the rate of inflation? And you can see this here. I'm going to zoom in quickly. So the blue shows the average savings account rate. So what can your dollar earn if you put your dollar in a savings account? And then we got inflation. And inflation is essentially how much the cost of living increases, right? We're kind of used to that. 2022, for example, saw 9% inflation. That was not fun. But so that's what these two numbers mean. And as you can see, one thing that jumps out to me right away is the red bar, meaning inflation, is much higher. So we got inflation is much higher than the interest in a savings account, the interest rate in a savings account. So what does that mean? It means if you hoard your money, you're trying to save your way to wealth, and if it's just in a savings account, well, inflation is going to eat that alive, basically. And we can see that here with the numbers. Year-end 2019, inflation was about 2.3%, while the average interest rate you would get in a savings account is about 0.5%, which is nothing, honestly. Here, third quarter 2021, this is when inflation was really ticking up. So another year later, like I just wrote out, 2022, we saw 9% inflation. A lot of that had to do with the stimulus checks, right? There was too much money pumped into the economy, but that's a lesson for another day. But in 2021, here we see again, inflation 5.3%, while, oh my goodness, literally 0.1% is what you would get in a savings account. It's not much. So inflation's impact on your money over 10 years. Over 10 years, if you have the value of savings without inflation, so if you literally hoarded your money and it just stayed the same, like the $1 10 years ago is literally worth the same as it is now, it could buy the same, then it would be $65,000 roughly. But with inflation for the last 10 years, would be less, about 10% less. So that means your purchasing power went down by about 10%, 10% roughly. So this here assumes that inflation is roughly 2% per year, which is actually a low estimate. On average, inflation has actually been greater than 2%. So in theory, you would have actually lost even more money. So on average, inflation is about 3%. It's been between 2% to 3%. So roughly along this time frame. Recent years, obviously, inflation has been much higher, but in general, it's been around that 2 to 3% range. So so not good, right? That means the purchasing power of your money has decreased quite significantly. And how do you combat that? You combat it with investing. Woohoo! And here's an example of the S&P 500, which if you're getting to know me, you'll realize I really like the S&P 500 biggest companies in the US, blue chip companies, essentially. And you can see, like, this here's the max view, at least in this particular graphic. And you'll see since like the late 1990s, okay, yeah, there were downs, right? We got the dot-com bubble here in 2000s. We got the mortgage crisis here in 2008. And then we got, COVID here in 2020. These are all ones that we probably remember very well, or at least heard of if we weren't alive at the time. So what happened? It went down. Yeah, it went down. And it went down quite sharply. But every single time, what happened? The stock market rebounded. It went back up. And if you were patient, if you kept your money, if you kept investing, and even better, you actually invested and bought at the bottom or whenever you saw the market going down, and you're here today, that's today, right? You're at a much better place, right? Okay, yeah, we are still experiencing volatility, but the point is, after every down, there comes a better time, at least according to history. Doesn't mean it's going to be like that in the future, but so far, that's the case. That's the trend. So just keep that in mind. So the goal would be, on average, the S&P 500 has returned between, I'd say, 8% to 10% in returns over the last 50 years or so. And what does that mean? That means investing beats inflation, which beats, in turn, putting it in a savings account. So that is the order, right? So investing, if you're really trying to build wealth, investing here is the winner because it beats inflation. All right, so with that, let's move on to step number 2, which is understand risk versus reward. This is a huge concept, and for me, I'm someone who's actually pretty risk averse, meaning I don't like taking risks that much, but it's really important to understand, okay, how much risk am I actually willing to take in order to get some sort of reward? Here it is, key point. If you want higher returns, you have to accept some risk. I mean, that's kind of like a key in life, right? You can't just sit padded up with styrofoam around you because you're worried and scared of the world. You won't meet people. You won't maybe make networks. Sure, okay, you have the internet, you have social media, But still, if you're very concerned about the potential dangers, you probably can't achieve the full potential that you might be able to. So there are some risks you have to accept in order to potentially get some higher returns. The question is, how much risk do you want to take, and what is your goal with these returns in the long run? That's what we're going to be talking about. So there are some smart ways to manage risk, like index funds, we'll talk about that, rental properties, and things of that nature. But first, let's actually take a look at the quantitative, the mathematical side of risk. And this is called, in investing at least, something that we know as the efficient frontier. Let's take a look at the graph. So this here is an example of the efficient frontier. It's a little bit simplified, but the concept stands. So we have on the y-axis, we have the reward, essentially, right? Or the return, the potential return. So that's the y-axis. And then the x-axis down here, the horizontal axis, is the expected risk that you could be taking. Obviously, the higher the risk, in general, one would assume the higher the reward. And the lower the risk, if we go to the left-hand side here on the x-axis, then we would assume lower return, lower reward. And that stands, but there's actually a phenomenon, and I'm going to show it to you here in a second. Now, take a look at this chart because I'm going to be zooming in on cash. Cash, we know, is a lower risk because it's not really susceptible to volatility. Okay, sure, there are some risks like inflation risk, but in general, there's not that much risk. And then what does that mean with return or your reward? It's pretty low. So this here is pretty low risk, and in turn, we have a low reward, right? And then, so that's for cash. And then if we go up, if we ratchet it up one step, we go to fixed interest. So these are things like bonds, for example. Maybe some people might count CDs into that, right? So fixed interest, what does that mean? It's a little bit more risky because you're locking up your money for a long period of time, right? So you're giving someone your money and you're like, okay, I don't want it for like 2 years or 3 years, or some people say 30 years. I don't care. You can have my money, and in exchange, I want all my money back, which is your capital, plus, or your principal, plus I want some interest in return for me lending your money. And so that is pretty low risk. Why? Because most of the time in bonds or CDs, you will get your money back most of the time, and you'll get interest. Okay, so that moves us up. That ratchets us up on this efficient frontier. The next ratchet is property. Right, so property, again, it's a little bit higher risk because it's illiquid, right? And we don't know if we can actually sell it, when we can sell it, and all that. But at the same time, so far, historically speaking, property prices have increased quite a bit, right? They've increased quite a bit. And actually, there's a big study, about 90% of millionaires, in one way, shape, or another, one form or another, they actually built their wealth through property in some shape or fashion, right? Some part of their wealth was built through property. So property is pretty lucrative. The next ratchet here is shares. So shares could be something like stocks, right? So this is talking more about the stock market. So again, there's more risk and there's more potential return. And then finally, the last ratchet here is alternative investments. We're talking private equity, we're talking hedge funds, we're talking distressed debt, we're talking those types of things. So these are things we probably aren't going to get into today. But what is one thing you do notice? One thing I notice is that the marginal utility, or the marginal return, I should say, the marginal return is much, much higher at the bottom, right? So when you have low risk, low return, than when you're looking here. So the marginal return, that is the key lesson here. The marginal return, so the ratchets here, right? The up over the Y versus the X amount is much, much higher versus here. Like you see this tiny little up and this tiny little over, it's basically nothing. What I'm saying here in very layman terms, what I'm trying to communicate here is that sometimes taking more risk doesn't necessarily lead to the same proportion of higher return. So again, also in a different way of saying this is if you just look at alternative investments and you're like, nope, I want to go for the highest risk possible so I can get the highest return possible. Well, guess what? You might not actually. Going one ratchet lower, these shares, getting stocks, for example, over alternative investments, it's a little bit lower risk, but really it's not too much lower return. Like here, if we're connecting, I'm going to use a different color because I'm painting a lot on this. If we're really like looking at the reward for shares, it intersects about right here. And for alternative investments, again, it's not really too much higher. But for that, you're taking on a whole lot more risk. So the difference is really not that much. Versus if we look at cash, where does it intersect the y-axis? Right here. Versus fixed interest, it's a little bit more risk. It intersects the y-axis here. Look at the spread. Look at the difference between these two. It's a huge difference, right? Versus this tiny little difference between these two. So what I'm trying to say is that taking more risk doesn't necessarily mean your reward is higher. So make sure as you start thinking about how much reward do you want, you take a look at this efficient frontier, because that is exactly the key point. And this shows it a little bit better too. The risk versus return, the dirty secret of moderate risk taking. It shows that as you take more risk, right, as it goes up, as your risk goes up, which is showed here in the blue. The blue is the risk, or I'm sorry, actually that's wrong. All right, the actual return is blue, so this is what you actually get. Like the reality is the blue line. The red line is what you would think, what you imagine your return would be, because you're taking so much more risk, right? So again, as your risk increases on the x-axis, so let's say your risk is here and 11, you would believe that your return would be proportionate, it would be commensurate to the amount of risk you're taking. But in reality, the return, the actual return, the blue line, it becomes less. You actually get less. Why? Because there's so much more volatility. And again, this is explained by the efficient frontier picture here. So again, very simplified, but the whole concept still stands. That is what the efficient frontier does. And that is supposed to help you better understand, hey, you don't necessarily need to take a ton of risk to make a ton more money. It doesn't necessarily work that way. And that's also, the efficient frontier also explains, to some extent, why it's important to have some sort of diversification. You don't just want to put all your eggs in one basket or in one company. It's good to have a little bit, some of your money in cash, some of your money in fixed interest, some of your money in maybe real estate, some of your money in shares, and maybe even some money in alts. But the point is, you have your money spread out over a larger amount, over a larger breadth, which lowers the overall risk. But we'll get into that another day. So moving on to step number 3, how to get these returns. So now we've spoken about potential returns and the risk. Let's actually get into how you can get it. So the key point is review existing funds that match your goals and risk tolerance. So some examples of funds that I personally would use if I were to do this all over again are below. So take a look here. Broad ETF, VTI, Victor Tango Ingrid is what I often call it when I speak to my clients. It's the entire US stock market, meaning we're looking at about it's actually 3,500 something stocks in VTI alone. VTI is an ETF, so you own literally the entire US economy. That's pretty cool, I'd say. So if one company goes bust, fantastic. You still have 3,500, 54 others out there. So not a big deal. Here we go. Quick snapshot VTI. We got an expense ratio of 0.03%, also known as 3 basis points. This is very cheap. Most of these funds are probably 0.75% or 75 basis points. That's how much they cost you, which means that eats into your overall return. And the higher the expense ratio, the lower the return, meaning the lower your wealth. So we don't want that. All right, so that's VTI. Another one I would choose is the S&P 500. Again, I do love the S&P 500. This one's called SPY. This is an ETF. It essentially has the 500 top companies, hence S&P 500 in the US. These are large blue chip companies, and the S&P 500 updates automatically. So if a company falls out of the top 500 companies, it updates and it brings another one in to replace it. So here's the SPY, SPF, sunscreen. I'm thinking of sunscreen. Here's a look at it from Morningstar. And again, we see on the equity style box, it is a blend and it is a large cap. So check out my previous videos. I do talk about the equity style box there. And all right, so that's one thing I look at right away. And is there anything else? Are we looking at the expense ratio? Okay. here we go. We're looking at the expense ratio, and this is about 9 basis points, which is a little bit more expensive than VTI, the previous fund we looked at, but still, again, nowhere near as how most other funds are in terms of expense ratios. Another one is dividends. So I do obviously want to get some sort of passive income while I'm investing. VYM is one of these dividend stocks. Again, most of the time, any ETF that starts with V automatically signals we're looking at Vanguard. So I know right away, just looking at the ticker symbol, we're looking at another Vanguard ETF, which I like. I personally am a big fan of Vanguard. So many companies have raised dividends for 25 plus years straight in this particular ETF. So that means these are probably pretty high quality companies. You're probably not going to experience too much growth. They're probably a little bit more stable. But for me personally, I like that, which is why I would choose this if I were to do this over again. And I like earning passive income. That's my thing. So here's a quick snapshot. Again, VYM, Vanguard High Dividend Yield ETF. We're looking at an expense ratio of 6 basis points. That's fantastic. Again, I'm really happy. You can also see this scale here, risk versus reward scale. So comparatively speaking, for the risk that you're taking, and dividend stocks really aren't too risky, if I'm being honest, the reward itself is very good. That's essentially what it's showing. So more means you're doing good. You're getting more money in your pocket and you're building your wealth, which is exactly what we want in this video. And then another one is a niche. So, I was very broad scale, and now I want to kind of niche down. And I personally like, technology. I like microchips and stuff like that. So I went for a niche ETF, again, also Vanguard VGT, which is a higher risk and potentially higher reward ETF. Check out the returns on this one. Just wait and see. So for me personally, this is what I would likely put into my portfolio. If you guys have any other niche ETFs that you want to share, please definitely let me know in the comments. I'm sure others would be interested too. So this here is a tech ETF. It's domestic, meaning it's US focused, and again, it's 9 basis points. So I'm pretty happy with it. And here's a snapshot of the actual return. So I'm just looking at the benchmark. The benchmark is essentially what is this fund compared to? Like, how do we compare? Like, okay, is this VGT fund actually performing well or not well? It's looking at the benchmark. I actually forgot the name of the benchmark. Otherwise, I would share it with you, but you can see the benchmark here. And then you can see the overall total return by market price of this particular fund compared to the benchmark. They're pretty similar, so they literally track it. But the point is, actually take a look at the returns here in this column. I mean, you got like 30%, you got 50% return, negative 30%, 30%. So my point stands that it's very volatile. So this is high growth, also high return, and high risk as well, as you can see with the volatility. So you got some single digit returns, and then you got some negative returns, and then you got some really, really high returns like this 50% in 2023. So overall, check it out. And again, I just like having the broad coverage and then some niche coverage. And then finally, or almost finally, step 4, second to last step, is execute, which is really important. You can study and learn all you want, but the execution part is so important, and starting early is so, so important. The key point here is the earlier you start, the faster it compounds. I have a chart I will show you. You probably have seen it before, but I just really want to drive this point home. It is so true. Millionaires aren't made by being perfect. They are made by taking action. That is the difference between millionaires and everyday people. They take action. And even if it's small action, even if it's just $5 or like $1 investing in a fractional share, that's okay. But you're taking action. That's what matters. And then these small actions, they build habits, and then habits build ultimately millionaires, at least from the folks that I spoke with, that I interviewed, and that I worked with in the past. So who's going to earn more? You got one investor here, this blue investor who started at 25, and then we got investor 2 who started at 35. So full 10 years later, investing $5,000 each year for 30 years versus investor 1, the blue investor, it just sets aside $5,000 for 10 years. That's it. Just 10 years investing, and that's it. Guess what? Even though this orange investor started 10 years later and literally put in so much more money, $5,000 each year for 30 years, the orange investor still is over $170,000 less. Still has $170,000 less. Why? Because of time. So the time value, that's something that you will probably hear or have learned. The time value of money, TV of money, is extremely like it makes a very big difference. So the earlier you start, the better, even if it's a small amount. This year is a lot of money for most people, right? $5,000 a year, especially if you're 25. Some people, it might not be doable, and that's okay. You don't need to put in 5,000. It could be like 100, but as long as it's something, that's the key. Couple of fun facts that I thought were interesting to know. 75% of millionaires, so 3 out of 4 millionaires, they literally said they built their wealth through regular, consistent investing over a long period of time. So it's not like buying the market or hedging the stock market in the 2008 great financial crisis. None of that stuff. It's just consistent investing over time. It's really not a secret. It's just consistency, just like with everything, right? Whether it's getting your degree, whether it's building your network, whether it's going out on social media and building a followership, it's literally consistency. And the same thing comes with building wealth. The top 5 careers, I wanted to show this to you because oftentimes I hear people who are like, oh, you can only be a CEO if you're a millionaire. You only have to, or you can only be a doctor or a lawyer or I don't know, like a tech billionaire or something like that. No, that's not the case. Top 5 careers for millionaires: engineer, CPA or accountant, teacher, management, attorney. Okay, these 2 make more sense, but these 3, like, totally possible. Anyone can do it. There are some pretty cool stories out there of folks who were working for the local garbage company or the local mail company, and they actually turned out to be millionaires. Why? Because they just invested consistently. So just some things to think about. 80% of millionaires invested in their company's 401k. So that's another interesting thing there. And about 80% of millionaires did not receive any inheritance. So a lot of people are like, oh, well, they're millionaires because their parents were rich. Well, 80% of them weren't actually. They made it on their own. So again, you can do it. Absolutely. You just have to follow these rules, and especially start early. That's so important. And then finally, the last step is reinvesting. So reinvesting is so important because it automates life. Like if you can automate your reinvesting, and I have 2 strategies here, it's going to make it so much easier because it's out of sight, out of mind. Here's the cycle. You earn money, you invest it first, then it pays for you. So you make it, it makes you dividends, or it just grows through compounding interest, and you reinvest any of that money. Here's how to do it. You reinvest dividends from stocks. Any stock you get, you automatically set it to a dividend reinvestment plan, also known as a DRIP plan. You will get the option as you buy ETFs with dividends. You can ask, or it asks you, hey, do you want to reinvest the dividend automatically to buy more of that stock, or do you want that dividend paid out in your checking account? I personally choose the reinvesting plan all the time. Reinvest cash flow from rental properties. So if you do get rental properties, reinvest it, put it in the stock market or put it into your property. And then grow your contributions as your income increases. No lifestyle creep. I know a lot of people, they started out with, contributing about 10% of their salary, which is decent. And then their salary grew, but they still only contributed the same dollar amount. They didn't actually increase the percentage. And that unfortunately really hurt their retirement prospects. So make sure you also always increase the contribution amount. So a DRIP, a dividend reinvestment plan, I just wanted to show you the numbers, the number crunching here of if you had reinvested your dividends, which is the blue line here, versus if you did not invest your dividends. Look at that spread. Look at the difference here. So big, so much of a difference. This is like what, 3.1 million versus 1 million. That's a big, big difference, right? So you would be missing $2.1 million had you not reinvested. So the key point, please reinvest your dividends. The power of dividend compounding, this here is for the S&P, this is for the S&P 500, growth of $10,000 in this time frame, 1960 to 2023. Take a look again. The blue line is you are reinvesting, and then the the gray line is no reinvesting. I mean, again, the numbers don't lie here. At least I hope they don't. And you can see 5.1 versus 800,000. I mean, that is what, a $6.3 million difference. I'm sorry, a $4.3 million difference. Sorry about that. That's a pretty big difference. So again, make sure you reinvest. And then another option here is the DCA. This is the dollar cost averaging plan. You probably have heard of this one before. Again, it should be automatic, and regardless of what the stock market is doing, if it's going up, If it's going down, if it's going sideways, we don't care. We're just reinvesting it at the same interval, the same time period, right? Over a set period of time. You're putting in the same amount of money, and it does not matter what's going on in the stock market. This is what I personally have been doing, and it's also what my clients have been doing. And guess what? That's how they build wealth. So overall, the key tip is don't wait for the right time. That time is right now. The right time is right now. So make sure you start building your wealth so you can achieve your goals, whether that's a goose farmer or whether that's going into the tropics or building a huge chunk of cash. So if you like this video, please like and share to help others. I would really appreciate it. And then please subscribe to my YouTube channel. It's _. We got an underscore here, MMW, for more cool insights. And then you can join my newsletter here at the bottom on the link description for more exclusive tips. Your bank accounts will thank you later. Thanks, guys.